Welcome to another edition of Focus on Alternatives, brought to you by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, please visit adisa.org and check out the resource library. My name is Greg Mausz. I'm your host today. I'm joined by Rick Chess. He's an attorney, he's a due diligence officer, and you've been in the space a long time working with clients and alts. And so today we're going to be talking about kind of smart moves in challenging times. You've seen the different market cycles through the 80s or 2000, the Great Recession, pandemic, and now we're here in this period of kind of big volatility. What do you think financial advisors should be doing to work with their clients and their clients' portfolios?
First, just listen to them, Greg, because sometimes what we think they're worrying about is not what they should be worrying about. And then try to get some of it liquid. One, because you don't know how turbulent it will be, but there's going to be some wonderful opportunities. They have a little dry powder. You're going to be a hero.
Yeah, absolutely. It's all about that dollar cost averaging on down. Any more specific advice other than dry powder? Should they also be repositioning?
Absolutely should be repositioning. One of the beauties of the alt space is we have so many products from so many sponsors in so many different places. That's what I'm saying. If you listen first to them as far as where are their fears, where have they had success, don't assume that because what you know is what they know, but spread their, get some diversity. But it isn't diversity of, I have apartments in Seattle, now I'm going to get apartments in Richmond. It's different asset types, different structures, different sponsors. Show that you are aggressively, creatively working on their portfolio.
Could not agree more. So many people put a diversified portfolio together of equities, and they should really be doing it on the alternative side as well.
Right, absolutely. I think, and the good news is, you've been president of ADISA, I've been president of the predecessor to ADISA. The whole industry has evolved where now we have hundreds of sponsors and hundreds of different offerings out there. Sometimes it's overwhelming, but it's well worth it. And again, you have due diligence officers in your firm. Lean on them, saying, look, I have clients that are a little bit concerned about this. What is available? What is coming out? And the due diligence officer on top of that.
Yeah, 100%. So, alternative investments are not immune to market volatility and market downturns as well. So how should advisors be thinking about which alternatives to use depending on the market cycle?
Well, let's step back for a second and saying, we have to protect ourselves, our broker-dealers and registered reps. And one of the things I've seen some folks now doing is putting a document in front of the investor saying, yes, I understand what I've just bought. Get the investor to write why they bought it, what they liked about it, what they were concerned about. Therefore, if ever there is an issue, it's like, well, this is what we talked about. But one of the things I do a lot of DST is, and one of my common questions are, what would you do if taxes weren't an issue? And there's some variation of that question you could ask every investor because you want to get them out of cash flow only or tax savings only. Getting an investor to think long-term, big picture is really difficult, but you got to do it.
Yeah, that's such a good point, is to document when you had the conversation and why that recommendation was made, the rationale behind it all. And it's oftentimes good to pull that back out if ever there's a question, like, why did we do that? And you can reference it. And that's just part of good practice management to protect yourself as the advisor, but also to remind the investor, here's exactly why we did this.
Another way of taking that is when I'm in my rep role and say you're my client and we've had a conversation, we discussed something, and there's always a question of will you remember later? I'll send you back an email and I'll have a first paragraph that's fluffy. The second paragraph, almost word for word, goes over what we said, and then I set up another meeting or ask you something that you have to respond to. So there's never any question. That's what you said. It's in the email. FINRA has kept a copy of it. And, oh, by the way, you did agree to the meeting. Think about that. Yes, the investors are critical, but they have very short memories. You can be doing exactly the right thing for them. Sometimes things don't work out. Make sure you have something there of what they really were going after. And Your great point, Greg, is help remind them.
Yeah, absolutely. So as your role in an attorney and kind of an industry veteran, you've been able to participate in FINRA arbitrations. So when something's gone sideways between a financial advisor and their client and a recommendation, what are some of the lessons learned from those arbitrations that you can share?
First one's a little scary in that there's usually a 3-judge panel, and generally only one of them has any clue whatsoever about alternatives. So be prepared, you're going to have to educate them. Your attorney's going to have to educate them. When you're on the stand, you have to educate them. 2, if it's something that's easy to find, like go on Google for 30 minutes and you didn't do that on a deal, that's going to hurt you far more than anything that's in a 300-page document. Again, remember, it's what that investor could have, should have understood, what you as a rep could have, should have understood, and also statute of limitations, no matter what they say, doesn't apply. So you're not going to be saved on that one.
Right. Well, due diligence is so important. It must be done kind of at that corporate level, but then that financial advisor must do his own and make sure that the suitability is really there. So yeah, you can't not do it, but you also need to document that due diligence.
But you hit on suitability. Every one of the 7 cases, when it really came down to what swung the case, it was suitability. It wasn't the investment per se. It wasn't the due diligence. Those are kind of, they're important. You got to be doing them on a regular basis. You'll get dinged on an audit if you don't do it right. But if you think at how, again, this 3-person panel, they'll be looking at this person, your investor, this deal, was it suitable? Do everything you can. One of the tricks of the trade I did, I worked as an attorney. There was 2 brothers, late 70s, in Atlanta, and they were investing in some Texas, going back a ways. And after the fact, the rep was like, I wonder if they really understood. So I had a video conference with them, and I talked about the Braves, and I talked about all the team, and just to establish that they were coherent. And I have on video them saying, well, cash flow is really not, no, the value in the back end is really not interesting to us. It's the cash flow today. That's pretty strong stuff.
Yeah.
So, if you don't want to do it or you haven't done it, hire an attorney, hire somebody who can then be brought in as a witness to say, not only do we have this email, not only do we have this thing signed, but, we talked to them. At that point, that slams the deal shut. You've won. I'm saying you should never have to get there, but sometimes it happens.
So what is it about suitability? So if suitability is really the hinge point here, what is it about it that's going sideways?
Number one is, does the investor understand? I know that sounds pretty simple. One case was in where husband and wife were acting like, well, we don't know how to read. And then you find out that both of them had very high-end jobs where, like one particular, she reviewed financial statements for students. That was her job for 30 years. So she knew finances really well. So those things that you think your client has, document it. Get them to show you something they do in their job. Ask them about their job. Have it. It's not just that they have a good paying job. Make sure they really can talk about it intelligently, because that'll just help you. So it also helps you sell the product in the first place. So the very things you're trying to do to be a good registered rep are also things you can do to help you protect yourself down the line.
Right. Agreed. There are, though, some bad actors out there. Sometimes it's on the financial advisor side, sometimes it's on the sponsor side. Mm-hmm. What can clients do to try to protect themselves from bad actors?
Well, most of the time, of the 35 years I've been doing it, it's not that the, quote, bad actor, it could be a sponsor, it could be a broker-dealer, goes into this business with an intention to do evil, but they start getting too much money. They start having too much. It's the same in politics, it's the same in business. It's nothing unique to our industry whatsoever. The need to monitor. So if a sponsor buys a jet, usually a bell should go off. If somebody who was a paralegal now is being made, who was making $50,000 a year, is now making $500,000 a year as a chief operating officer. These are real cases. Mm-hmm. So don't assume that because something or somebody was right, they still are. And I would tell you that about the investors too. Investors change. What's going on in there? They're going through a divorce. They get hooked on drugs, et cetera. Once you've made that investment, you have to monitor the sponsor with help from your broker-dealer. You have to monitor your client as part of your ongoing follow-up. And the more you do that, the more you have that in the file, and you can bring that up in an arbitration, the other side just folds.
No, it really comes down to doing the right thing.
Absolutely.
And documenting what you've done.
Yeah. Well, you say that. I mean, when I'm meeting with folks who want to become a sponsor, and my phrase to them is, you will do the right thing because of who you are, not because of the regulations, not because of any white papers, whatever. Those are what you should aspire to. That's what the due diligence officer should be using to say, do we do work with them or not? But morals, ethics, background, experience, those personal things, are very, very important. And it's kind of the same things that you would use on, do I want this family to be friends with our family? It's a little more complicated, but a lot of it is stuff you already know how to do. And unfortunately, a lot of reps are reticent. Oh, this is a big company. Yeah. So what?
Right.
So
on your experience, are there any security structures, any asset classes that should always be avoided?
You were going well until you said that always be avoided. I don't think there's any structure, asset type, whatever you should always avoid. But there's a difference between, let's say there's a company that's bought existing apartments for 30 years, and now they're going to develop shopping centers. It's a different rhythm. Mm-hmm. I mean, I was at United Dominion Realty Trust, and we were really good at apartments. I bought 50,000 apartments for them, and we thought we were hot. But we started buying RTC products. So we went from old, which was clean, safe, and cheap. That was our mantra, to newer stuff where we had to push rents. We know how to do that. We kept controlling expenses. And eventually, all the senior management got laid off. So when you're looking at your sponsors, you're looking at the offering, it's nice if somebody there has done that before. It would be great if, even if they're not something they've done before, is the timing. Short-term leases, self-storage, hotels, versus 20-year-long industrial leases are a very different rhythm. So if somebody's a tango dancer,
right,
you don't necessarily hire them to go with you on the foxtrot or something. I mean, it is that kind of, and I use those analogies, one, because it works in court, it works in arbitration. Your clients understand them, and it's easier for you to remember. Mm-hmm. So, think about what you're doing in terms of stuff you've already experienced, and I think you'll be much more successful.
No, and that's right. You also have to find that right strategy based upon where the market dynamics are. You try to buy on that dip and not at the peak of the market. So thank you so much for sharing these valuable perspectives. And thank you for watching another edition of Focus on Alternatives. We hope you enjoyed it. For more information like this, please visit adisa.org. Thank you.